Hello and welcome to this week's edition of Retire Well, where we're committed to building better lives. I'm your host, Kristin Oakley, and I'm joined in the studio by the co-founder of Citizen Advisory Group, Kevin Bucher, and financial advisor, Sean O'Drobenek. We're so glad you're joining us today. We are going to continue a very important conversation that we started having last week, all about the one big, beautiful bill that recently passed, and most importantly, what it means for you. What does it mean from a tax planning and saving standpoint for retirees? Well, you're going to want to hang with us to find out. Kevin, Sean, are you ready to tackle this thing one more time again this week?
Let's do it. Well, there's a lot that we didn't unpack yet, so there's still a lot to this bill, and we'll do our best to keep things moving along, to get to as much of it as we can.
For sure. Well, we said this last week. There's a lot to know. It's been really hard for folks, even those of us working in the industry, to get a hold of the solid information that exists about these changes. But this is one of the things that really does set the team of Citizen Advisory Group apart. They have access to special resources. They stay on top of this information so that they know how to best help and serve their clients and navigate through these legislative changes successfully. So I know not everyone probably tuned in last week, so we need to do a quick recap of what we've covered already and kind of catch people up to speed. So Kevin, let's start with that quick recap of these legislative changes and why retirees in particular need to care about them.
Yeah, so legislative risk is one of those risks that can affect your finances throughout your life, and in particular when we get into retirement. So it's not that it's the only risk, and I don't want to paint the picture that risk means that it's some terrible, nasty thing, because there's all different types of risk. There's market risk. Well, I think we all know that sometimes the market's good and sometimes the market's bad. Well, that's market risk. There's interest rate risk. We're also subject to changes in interest rates. So sometimes they're high, sometimes they're low, and depending on what side you are on the loaning and using of money, depends on if that's a good thing or a bad thing. So there's all these different risks, but risks are not always bad. Legislative is one of those. And so when we're talking about legislative risk, it's policy change. It could be policy changes around Social Security, Medicare, and then you have this one big, beautiful bill that is pretty robust, but it had some changes to the tax code.
Yes. Yep, and it depends on how you file your taxes too, whether you are taking the standard deduction or itemizing. We're going to dive more deeply into that today. But Sean, why don't you give us a high-level overview of, as we are affectionately calling between the three of us, the OB3, right? The one big, beautiful bill. Why don't you give us that recap and overview, if I can say those two words together, and the key changes that retirees need to be aware of.
Yeah, so there's three kind of that are affecting us here and how the community that we serve, right? So there's a change to charitable giving. There was a change to the standard deduction, and then there's this senior enhanced deduction, right? So to Kevin's point, there was plenty of other legislation in this, but we're really going to focus on that because the overall goal is to simplify taxes for these retirees, for these individuals that are on a fixed income, right? That's basically the premise of this particular bill and how it's going to affect the people that we serve here in Perrysburg.
Okay, so we're going to get through these three key components today. I know real-world examples are the best way to illustrate some of these changes. So Kevin, walk us through an example. What does the standard deduction look like now for a married couple who are both 65 and filing jointly?
All right, so I'm going to throw some numbers to this. So we got a married couple, so they're filing jointly. So the standard deduction went from $30,000 to $31,500, and that happened immediately. So the standard deduction, the amount of the income you get to deduct away, there was a $1,500 raise. And then they also added this enhanced senior deduction where each individual over 65 gets an additional $6,000 deduction. So if I put some numbers to this, if you're 65 and older, married, filing jointly tax return, you get a $31,500 standard deduction. Well, folks that were 65 plus already got an additional $1,600 each. So that's another $3,200. So $31,500 plus $3,200, and now we get an additional $12,000 for a married couple, both getting the $6,000. So we're talking about $46,700 of deductions. So you get to take your adjusted gross income and wiped away $46,700 of that to determine what part of your income is subject to taxation.
Right, what your modified adjusted gross income actually is,
Yeah,
right?
so that is a huge amount of income you get to deduct away before you have any tax liability.
Right, yes. So that's a good thing.
That is a great thing.
But
I think it's a great thing.
There's a couple catches you mentioned last week, right? Like income phase outs and things of that nature.
And that's where, I think we talked about the urgency, and what this bill did, it created opportunity for basically everyone for the next 4 years, right? So when there's an opportunity, we should at least be prudent about what we do and maybe take advantage of it, because to Kevin's point, the standard deduction is so significantly higher now. There's room to do some things, right? Last week we talked about Roth conversions, but we also talked about how it's going to affect your income, right? And if we Roth convert too much, we may overpay. It increases the flexibility. Because there's opportunity, we should look at it, but it's not as easy as A plus B equals C. You're going to like that, being a former math teacher, right? Right. But going back to it, it's a complex situation. We got to figure out how much can we do while still getting the income, while not overpaying for our Medicare.
Yes.
Yeah, and 2 quick points about this enhanced senior deduction that we referenced. Number one, this was an immediate part of the tax legislation change, right? So this is for tax filing 2025. There's this immediate additional deduction, but this is also one of the pieces of it that's not part of the permanent. This is set to expire. This is not permanently in the tax code. This is through 2028, and it could be brought back in, but it's not part of the 2029. So it creates this window, this sense of urgency that we need to address and take advantage of any opportunities that this might present in the overall plan.
For sure. One of those opportunities also has to do with charitable giving. So can you speak to that change and what our folks need to understand about that?
Yeah, number one, if you are charitably inclined, thank you, right? Because I think it's a gift, it's a spiritual gift that people have that they just so if you are spiritually, if you're gifted with the spiritual gift of giving, there's opportunity for you within this tax code, right? Because before you pretty much had to itemize in order to give, right? We'll talk about QCDs a little bit down the road, but specifically to the charitable deduction, I mean, you can actually claim some deductions even if we're filing standard, right?
Even if you're taking the standard
deduction. Yes.
Okay.
So that's a huge change, but now you're going to have the conversation of, well, if I can give and I have that spiritual gift, when do I itemize? Should I itemize? Have I always just taken the standard deduction and I've given with my best money? There's a strategy there that you can take advantage of by maybe potentially itemizing and getting these additional benefits in order to do what your heart so desires and give philanthropically. So
there's opportunities.
There's opportunities, absolutely.
Yeah, I know. We were saying before the show, we can only really go at a high level. I mean, the real way that you're going to be able to help folks navigate through this is by them coming in, sitting down in the privacy of your offices one-on-one and looking at what all these changes mean for them, because there's no one-size-fits-all approach.
No, and because everyone's individual circumstances are so different. And I think as an industry, we try to look for ways to put people into a box so that we can just repeat the same thing over and over again. But the reality is everybody has different resources, they have different goals and objectives with their money. So it does require customization of the plan, and this is just one of those areas that requires that customization.
Well, while a lot of these changes are favorable, really the bottom line for our viewers is it's time to take a fresh look at their tax strategy, right?
Yeah, and from my experience when it comes to tax planning, a lot of times folks are not that as well versed around taxes as they would like to be, so they're just kind of a victim of having their taxes done and then paying the bill. But what we want to do is just try to help people get informed and try to take advantage of the opportunities that exist. So if you're not quite sure what you need to look for, or if you have a financial advisor that's not providing you with tax advice, which is the common situation that we see, well, take advantage of the opportunity to come in and meet with one of our advisors who are going to roll up their sleeves and they're going to look at how this one big, beautiful bill is affecting you and show you what opportunities you have to make adjustments to your plan. It starts by picking up the phone and making that call today, but it might save you and your family thousands of dollars in tax and lost tax dollars over the course of the next 10 to 20 years of your financial life.
Bottom line, guys, I don't think folks can afford not to call, right? So Kevin, Sean, thank you so much. We encourage you to reach out. We know that a lot of these changes can be confusing, and specifically knowing how to best navigate them for you and your situation. But here's the good news. The team of Citizen Advisory Group is here to help and serve you. You don't have to go it alone, but you do have to reach out. So we encourage you to pick up the phone and call the number on the bottom of your screen to receive your very own complimentary retirement checkpoint review. 866-630-1675 is that number to call. Or if you'd rather connect online, simply scan that QR code and that will get you connected as well. Stay with us. So far on this conversation, we've talked a lot about the standard deduction. What about for those of you who might be itemizing on your taxes? Stay with us to find out about those changes right after this.
As a youth, I spent my summer months on the construction sites with my family. I think I learned early on the value of hard work. Ultimately, though, I was led into the financial services world where I joined my brother Jeff.
We were like many other financial advisors where, it was mainly transactional, but we felt there was just more. And I started to notice that the very, very wealthy families around the country had financial advisors that provided service to them that was really unparalleled. And it was always puzzling to us, well, why can't everyday hardworking people have that same opportunity?
I think we pride ourselves on the comprehensive services that we offer, which starts with the holistic financial planning. Our logo initially was a mountain-based theme, which was meant to kind of highlight the accumulation years where you're building and saving your resources for retirement, and then the backside of the mountain where you're working your way down in the distribution or income years.
I think many people think that the financial piece is just so prevalent and the most important component, but there's just more to it than that. It's about the experiences, it's about the relationships, it's about the life that our clients are living. As we looked in the future, we said, you know what, we need a logo that tells that story. It's our family coming together with your family. It's your financial pieces coming together to have a coordinated plan. It's our community coming together to keep that social connection. All of that coming together as one, and I think this logo beautifully illustrates we build all of this together to get the most out of your retirement so that you can have the retirement that you've always dreamt of.
Welcome back to Retire Well. I'm Kristin Oakley here with both Kevin and Sean from Citizen Advisory Group, and we're so glad that you're joining us today. If you're just tuning in, today's conversation is a very special part 2 conversation we are having on the One Big Beautiful Bill, specifically how it might be able to help you potentially save thousands on your tax bill over the next 4 years. Of course, we know that this current law change is in effect through the end of 2028. We want to help our viewers take advantage of it. So we've spent a lot of time so far talking about the changes with the standard deduction. We know that a lot of our viewers watching might be doing itemizations when it comes to their taxes. So remind us about itemized deductions and how these changes are going to affect folks that fall into that category.
Absolutely. So for the most of our viewers and most of the people watching, they probably file with the standard deduction. What does that mean? That means you're not really counting your expenses, you're not keeping receipts, you don't have QuickBooks, you're just going to take that standard deduction, and whatever the government says, that's what we're going to take. But there are a few individuals who actually track all of these expenses, right?
And they might, why would that be? They're in business for themselves, right?
It could be a multiple different reasons, but yes, a business owner is a common a person who likes to itemize.
Yep.
Okay, so what can we itemize? We can itemize our mortgage interest. We can itemize some state and local taxes, some medical expenses, and again, if you're charitably inclined, we can itemize that as well. So where does this make sense? Well, it starts to make sense when those costs and those expenses are higher than what the standard deduction is actually going to give. Mm-hmm. And if that makes sense to you, well then let's see what it means to itemize these, take the itemized, and then continue with that deduction in your annual tax plan.
Mm-hmm. Mm-hmm. Yep. So it's interesting because I think some folks might have done it one way prior to these changes, and it might make sense to do it a different way, right? I mean, that's what I think a lot of people are going to have to navigate through for folks who have itemized in the past or who've just taken the standard deduction in the past.
Yeah, because there's been enhancements to both. So it's very worth the process and exercise to determine which way makes the most sense for you.
Right.
And then there's also maybe some opportunities that we'll get to hopefully a little bit later in the show where you're very strategic about this year I'm going to file itemized and I'm going to do my expenses a certain way, and then next year I'll take the standard. So we'll hopefully get to that.
Getting fancy on us here.
Yeah, I don't, yes. So it's hard to get to fancy because it takes time.
Yes.
But so, you know, the big change for those filing itemized is the changes to the SALT tax.
Okay, so something that's known as the SALT tax. So to go ahead and define that for us.
So it's basically your state and local taxes, and there is, so that's one of those deductible expenses that Sean mentioned if you're filing itemized. So before I get too far into the weeds on that, let's just take a look at some of the itemized expenses that fall on that list. Number one is mortgage interest. So maybe this is pretty timely relief for those that are filing itemized deductions, because interest rates have done what on mortgages? Well, they've shot up. So if you have higher interest that you're paying now, well, maybe looking at your itemized is going to make sense. We've also seen in our area, and I would suspect across the country, that property taxes, this is one of those SALT expenses. Well, people's properties have appreciated quite a bit in value, and the county auditor offices have caught on to that, and they're raising property valuations, and people's property taxes have gone up. We've seen that time and time again in our office. So it's a little bit of relief now that they've enhanced this SALT tax deduction, because those property taxes are one of those calculations. So prior to this bill, there was a cap on how much of your state and local taxes could be a deductible expense, and it was a cap of $10,000. This bill has raised that cap to as high as $40,000. So
that's a 300% increase.
That is not a little increase.
No, yeah.
I am just super stoked that we keep doing quick math on this show.
Yes, former math teacher. Right?
Yeah, right.
So kudos to you guys on that. But so again, we look at these itemized expenses. In some areas, they may be higher. So and now we have the extra SALT cap of going up to $40,000. So again, reevaluating the itemized deduction processes versus the standard is certainly going to be a worthwhile process. But there certainly is some relief there for those that are filing itemized and have historically done so.
For sure. Well, how might this change retirement tax planning strategies? And, you know, Kevin already mentioned, Sean, that it could change one year and the next year you would do something different. Walk us through why that would be.
Well, I mean, there's a couple different things. Number one, it could influence where you actually retire, right? So I have a client who actually just recently retired to Tennessee, right? And if you know anything about Tennessee, now he did it because of family reasons, but that actually helped him in the long run. So where to retire, you know, makes, you know, those high state taxes become a little bit more attractive for these retirees because of this itemization increasing 300%. So that's just one area. I have another client who, you know, is charitably inclined, but they also see the value of tax planning. So by going down the itemized route, we are actually able to give more than they ever thought that they could give, right? While converting some of this money. And then ultimately they love their kids so much they're giving their kids some money at the end of the year, right? So not to mention they have, you know, some long and short-term capital gains, right? So long and short-term capital gains with the itemized, with your ordinary income, with Roth, it becomes a little complex and a little cumbersome over time, but that's why it takes a team of professionals, because I can understand this to a degree, but I need to walk down the office and I need to go and talk to the tax team. Hey, this is what we're thinking. This is what the strategy is. How do we best utilize this from the taxes to the income to their investments to ultimately accomplish what the client wants to do with this money, because that's their legacy, right? This is the legacy that they want for their money. How can we partner together in order to accomplish what they want to have happen? It's a fulfilling job that there's a lot of pressure, right?
Yes.
But it's absolutely fulfilling to do it as well.
Well, and it struck me. I mean, I've walked to that section of y'all's office, so I know what that walk is like, and taking plans down there, I can see that process happening. No two plans you're building for folks are alike, because I think we always say there's no cookie cutter approach, but especially when it comes to tax planning, everybody's situation is so unique and different. And I guess My next question would be that with the lower tax burdens that things like SALT and all these other changes are creating, should retirees adjust their withholdings? Is that part of the conversation?
Yeah, well, it certainly is a part of the conversation because it's not, there's benefits in adjusting your withholdings that go beyond just the fact that there's less going to the IRS for that annual tax withholding, right? So the adjusting the withholding has a long-term impact because if I'm sending less to the IRS out of my pension check, or I'm sending less to the IRS from my portfolio withdrawal, well, I can reduce the withdrawal that I'm taking from my investment account and still put the same amount of money in my pocket. So I guess there's another side of that. That if I adjust my withholdings so that I don't owe as much in taxes, I'll have more money to spend. So, but if you don't need more money to spend, you can adjust your withdrawal down, which has a compounding impact in other areas, not just to your taxes, but to the longevity of your financial plan.
Right. Yeah.
So there's so much benefit to this, but we have to be proactive in taking advantage of the opportunities that exist. And you know, we're highlighting the changes as part of this bill, but this is not a new thing. This is part of financial planning. We need to understand how your taxes impact your investments and your income so that we can have these things working very well together so that your money is doing what it needs to do and you are keeping control and giving less of it away to the IRS.
And this is why you've said, Sean, I heard you say this earlier in this conversation, that lower taxes can actually make someone's retirement portfolio last longer, right?
No doubt, potentially, right?
Yeah.
So if we're going to take less off of our portfolio, well, what does that mean? That means we need less income, which we're going to leave more exposed to a market position. And if we have more exposed to a market position, potentially, or whatever position it may be, it's going to grow for a longer duration of time. And most advisors and most people, what happens when you become, 65, 66, 67, you reduce your risk of the portfolio. Well, when you do that, you're also going to reduce your return, right? So we have to take a strategic approach to where we actually separate what do we need? What do we need to live off of every month, every year for the rest of our life? Take the least amount of that, fill that income gap, and put that so we know it's going to be guaranteed predictable for the rest of our life, right?
Yep.
So that if we have a reduced withdrawal strategy because of the tax changes here with this OB3, well, this money can now make some more money potentially, right? Because what people sometimes forget, you don't just retire for 1, 2, 3 years, you're retiring for the rest of your life.
Right.
And that may be 25, 30, 35 years, depending on when you retire.
Yeah.
Well, that's a long time. And if we just reduced our overall portfolio strategy because we have one metric, one demographic saying, hey, we need to reduce it and bring some conservative investments in here, we just think there's a better approach to it, right? So we evaluate it holistically and we look at what's the least amount that we need to cover that income gap, right? With taxes in mind, so that maybe we can take a little bit more risk. And if we're taking less because we need less, maybe we're gonna make a little bit more in the long run.
Bottom line takeaway I'm taking from this segment is that it's time to get a review. Reviewing all these things and what it means for you, your withholdings, your withdrawal strategy, and how might you potentially be able to keep more of your hard-earned money. If these are things that are resonating with you, if you have questions about how these recent changes could affect you in your situation, again, this is why the team of Citizen Advisory Group would love to be able to provide you with that complimentary retirement checkpoint review. 866-630-1675 is the number to call to claim yours, or again, you're welcome to click that QR code. That will get you connected as well. We'll be back with more right after this.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the 4th worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Kevin Bucher of Citizen Advisory Group. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. We specialize in retirement planning, tax mitigation, legacy planning, and so much more. Plan your retirement right. Call now for your own complimentary portfolio review and written financial plan.
Welcome back to Retire Well, where we are unpacking the One Big Beautiful Bill, specifically what it means from a tax planning standpoint for you and especially for retirees. I know we only have a couple minutes left, guys, but we want to talk about two key strategies. The first are bunching strategies. Can you explain what those are?
Yeah, so we're talking about how to play the standard deduction and the itemized deductions off of each other. Because in a typical tax year, maybe you don't have enough itemized deductions to be the same as the standard deduction, right? But what if you load up in one year these itemized deductions by paying your state and local taxes on a certain schedule, paying those property taxes on a certain schedule, so that you're loading them all up onto one tax year, artificially increasing your itemizable expenses. So that, okay, now it makes sense to use the itemized deductions for this year because we have more deductions than the standard. And then in the next year, you've already prepaid a lot of those state and local taxes and property taxes. So now you revert back to the standard deduction. So it's a bunching strategy where you're just loading up the expenses in one year that you can itemize, and then you don't have them in the next year, but you get to take full advantage of the full standard. The whole concept is we want to be able to deduct away as much of your income over the 2-year period as we possibly can.
For sure. Now, real quick, QCDs, qualified charitable distributions, you mentioned those earlier, Sean. What do folks need to understand how those work under the new tax law?
Again, if you are charitably inclined, right, and you're giving money away and it may be coming from the income source that you generated, you're doing yourself a disservice, right? So through the QCD, we can actually take some of that pre-tax money and send it straight to the charity that you support. And it's like it never even hit your tax return, right? So it does not count towards your taxable income, and it does count towards your RMD, right? Time and time again, when we're speaking or we're talking about QCDs, this is one area that they ask, what is that, and how do I actually best do that? So, and here's the other component is that you can do it up to $100,000 each year.
Yeah, well, and actually for 2025, it's $108,000, and it's for folks who are age 70 and a half or older. So two key important things to know, right?
Yeah, you got to be 70 and a half to be able to utilize the QCD. And going back to something we mentioned earlier on the show, this is an above the line deduction, so it could actually also reduce the taxable portion of your Social Security, compounding the tax benefits of the QCD and the charitable gift.
Well, I don't know how we wrap up such a big conversation, but any final parting thoughts you want to share with our viewers this week?
Take action.
Yes.
Take advantage of these new changes and put yourself in a better position for the future.
For sure. I think that sums it up so well. So Kevin, Sean, thank you both so much. To our viewers at home, you can take action today by calling 866-630-1675 and scheduling your very own complimentary retirement checkpoint review. Be safe, be happy, be blessed, and we look forward to being back with you next time here on Retire Well.